welcome new students. So today we are going to discuss about underwriting of shares and debentures from corporate accounting 1 in block 1 unit 4. This is Dr. Murugesan, Associate Professor, Wales Institute of Science Technology and Advanced Studies, Pallavaram, Chennai. Let us see what is underwriting. So underwriting of shares and debentures. What do you mean by underwriting? Meaning of underwriting. Underwriting refers to the functions of an underwriter. An underwriter may be an individual, a firm, or a joint stock company performing the underwriting function. Underwriting may be defined as a contract entered into by the company with persons or institutions called underwriters who undertake to take up the whole or a portion of such of the offered shares or debentures as may not be subscribed by the general public. Such agreements are called as underwriting agreement. An underwriter is a person who agrees to take a specified number of shares or debentures in case of not subscribed by the general public. So that individual or an institution are called as underwriters. So for that underwriting work, they will get some commission or remuneration that is called as underwriting commission. So as per it is a lawful for a company to pay commission to an underwriter subject to the following restrictions according to section 76 of the Companies Act 1956. They have given some uh, uh, instructions. So the payment of commission is authorized by the articles of association of a particular company. The second one is the commission paid or agreed to be paid does not exceed, in the case of shares, 5% of the price at which the share are issued or the amount or rate authorized by the article, whichever is less. So the amount does not exceed, in case of shares, 5% of the price, then or rate authorized by the article. Whichever is less, it should be applicable for the underwriter getting as a commission. The commission paid or agreed to be paid does not exceed, in case of debentures, 2.5% of the price at which the debentures are issued or the amount or rate authorized by the article, whichever is less. Looks like the previous one. So the price of the debentures, 2.5% of the price or the agreed amount or the rate authorized by the article, whichever is less, should be applicable for the commission paid to an underwriter. The rate of commission and the number of shares which person have agreed to subscribe absolutely or conditionally are disclosed in the prospectus. However, brokerage can be paid in addition to the payment of commission. So, if in case the general public not uh, subscribed, so the remaining shares should be kept with the underwriters. So for the purpose, they will get some brokerage in addition to payment of commission. So commission should not be given on those shares which are not issued to the public. So if in case it does not issue to the public, instead of the underwriter kept themselves. That means they can't be able to get the commission. If they offered to the general public, if they not subscribed, then only they will get the commission for the unsubscribed shares or debentures. The balance sheet of a company prepared according to the prescribed form should also disclose under the head miscellaneous expenditure all sums payable by way of commission or brokerage, etc., to the underwriters. So generally in balance sheet, the commission of underwriters or brokerage of underwriters for issue of shares and debentures should be posted under miscellaneous heading at the end of the asset side of the balance sheet by each and every company. Pursuant to the guidelines issued by the Stock Exchange Division of the Department of Economic Affairs, Ministry of Finance, by their letter of 7th May 1985, the following rates for payment of underwriting commission brokerage and managing brokers' remuneration are in force. So they have given some classifications. Based on that, they will classify how much amount or how many percentage they will get as underwriter commissions. So particulars, then they should classify it into two category. On amount devolving on underwriters, mentioned in percentage. On amount subscribed by the public, they have mentioned as a percentage. So how much the shares are debentures subscribed by the public, they will give certain percentage, or the underwriters kept themselves, they have given certain percentage. So for equity shares, they will get 2.5 percentage in both the cases. Second category, they have given preference shares are convertible and non-convertible debentures. They have given again two classification for amount up to rupees 5 lakhs, 2.5 percentage for underwriters category, 1.5 percentage for subscribed by the public. Then second category for preference shares and debentures for amount in excess of rupees 5 lakhs. The underwriters keep themselves means they will get 2 percentage of commission. If in case subscribed by the general public, the underwriters get 1 percentage of commission of the total value. So types of underwriting. We have three major classifications of underwriting. First one is complete underwriting. Then second one is partial underwriting. Then followed by the third one is firm underwriting. We will discuss one by one. What is complete underwriting? So complete underwriting means the entire issue of shares or debentures of a company is undertaken. It is said to be full or complete underwriting. Such an underwriting may be done by one underwriter or by a number of underwriters. If the full issue is underwritten by one underwriter, then his liability will be equal to the number of shares or debentures underwritten minus shares applied for. That is their liability. At the same time, if there are more than one underwriter, then allocation of unsubscribed shares or debentures amongst themselves is made pro rata. That is, in the ratio in which the number of shares or debentures underwritten bear to the total number of shares or debentures offered for subscription. So that is the pro rata basis. They should get their liabilities as well as their commission under this. If more than one underwriter is involved. The second category of underwriting is partial underwriting. If a part of the issue of shares or debentures of a company is underwritten, it is said to be partial underwriting. Such an underwriting may be done by one underwriter or by a number of underwriters. In case of partial underwriting, the company is treated as underwriter for the remaining part of the issue. For instance, a company issued 1000 shares and 40 percentage thereof is underwritten by nickel. Out of 800 applications received, the marked applications are 350. That means 350. So now we should calculate the liability of nickel. That means the liability of underwriter. As per the example given, the underwriter name is nickel. So gross liability of nickel. So the total number of shares offered by the company is 1000. So out of 1000 he will get 40 percentage. So 40 percentage of 1000 shares is 400 shares less the market applications. The market applications for nickel is 350. So we should deduct the market applications from gross liability of nickel. We will get net liability of nickel is 50. So 50 shares is his liability. Right. Then the third category of underwriting is firm underwriting. It is an underwriting agreement where the underwriter or underwriters agreed to buy a certain number of shares or debentures irrespective of the number of shares or debentures subscribed by the public. So in this case, they will voluntarily get certain number of shares or certain percentage of shares from the company irrespective of the general public subscribed. Okay. So thus in firm underwriting, the underwriters agrees that a certain number of shares be allotted to them, whether or not the issue is oversubscribed. When an underwriter enters into an agreement with the company, the purchase certain number of shares or debentures, irrespective of the public subscription, in addition to the open writing, is known as firm underwriting. Thus, under firm underwriting, the underwriter agrees to take a specific number of shares or debentures in addition to the unsubscribed shares or debentures. That is called as firm underwriting. So we have two major important classifications in the applications: marked and unmarked applications. What is marked application? What is unmarked applications? We will discuss. Generally, shares or debentures issued by a company are usually underwritten by a number of underwriters in an agreed ratio of the whole issue. Each of the underwriter tries to sell the shares or debentures at the maximum in order to reduce the risk of liability. Therefore, a method of marking the applications form with the stamp of the underwriter is adopted. So this facilitates to distinguish the form of one underwriter from that of others, and becomes clear to the company to know the exact number of applications received through the particular underwriter. Such applications with a stamp of an underwriter are called as marked applications. So each and every underwriters have a stamp. So if in case they sell it their liability, that means the company allotted shares by themselves, means that is called as market applications. In some cases, public get the applications form directly from the company, and such forms do not bear the stamp of underwriters. Such applications which does not possess the stamp of underwriters are called as unmarked or direct applications. So without the stamp of underwriter, that application is called as unmarked applications or direct applications. That is the major difference. If in case it is marked stamp, means it is called as marked applications. If without the stamp of underwriters, that is called as unmarked applications. So state how to calculate the liability of underwriters in different methods. So statement showing liability of underwriter under complete and partial underwriting. So for example, we have taken for more than one underwriter. They are called as A, B, C. So we should create the format: particulars, underwriter A, underwriter B, underwriter C, then the total shares or debentures. First, we should mark gross liability of each underwriters and put the total of three underwriters. Then less marked applications should be informed in the problem or by the company in the question. So we should first deduct the marked applications from the gross liability. After that, we will get certain liability. Then from the balance liability, we should reduce the unmarked applications also. Then based on the gross liability ratio. Gross liability ratio we should calculate from the different underwriters. For example, A's gross liability 3000, B's gross liability 2000, C's gross liability 1000. That means the gross liability ratio is 3 is to 2 is to 1. So based on that, the unmarked applications are also deducted from the liability of underwriters. Then only we should get net liability of underwriters. This is the format for complete and partial underwriting methods. Then the next format is statement showing net liability of underwriters under firm underwriting. We should calculate under firm underwriting category if the firm is marked and if firm is unmarked. I should give in a simple format for both the methods. So again, we should open for more than one underwriters. So particulars, that here underwriters name is called X, Y, and Z. Then we should put the total column. So gross liability looks like 3,000, 2,000, 1,000 less marked applications, then we will get some liability of underwriters. If in case it should be mentioned in that problem, marked firm or unmarked firm, that comes under the category of firm underwriting. So less firm underwriting if marked firm. Otherwise, if unmarked firm means no need to less firm underwriting, we should directly less unmarked application. If in case the firm is marked as marked firm, then we should deduct first uh, firm underwriting, then followed by we should deduct unmarked application on the basis of gross liability ratio. Then we will get net liability of underwriters. If in case any underwriters have some surplus, it should be borne by the other underwriters. In case in this format, is it have some surplus? That means the surplus of Z's liability to be borne by X and Y, the remaining underwriters, as per the gross liability ratio. Then again we should add firm underwriting. Then only we will get total liability of underwriters. That is the format for firm underwriting. If in case the firm is not marked as unmarked firm, that means we should eliminate the second step, less firm underwriting. Then the remaining formalities is same. Model journal entries given for few concepts that means for underwriting. So for shares subscribed by the public, that's a normal entry. Bank account data to share capital account being share allotted to the public. Then second one is for underwriters liability. So what is it? Instead of bank to share capital, we should post underwriters account data to share capital account being shares to be taken by the underwriters as per underwriting contract or agreement. Then followed by the third category is for underwriting commission payable to the underwriters. So underwriting commission account data to the underwriters account as per the golden rules of accounts we should use it. Underwriting commission comes under the category of expenses. Underwriters it's the receivers. So underwriting commission account data to underwriters account being commission payable as per agreement. Then followed by the net amount receivable from underwriters. If in case any amount received from the underwriters, so we should the entry is bank account data to underwriters account being amount received in settlement from the underwriters. So we give some number of shares and debentures to the underwriters. Then we will they will settlement made to the company. That means the entry is bank account data to underwriters account. So these are all the model journal entries for these transactions. Now we will solve the problems. So problem number one. A company issued 1 lakh shares valued at rupees 100 per share. The share were underwritten as follows. Mr. X, Mr. X 30,000 shares, Mr. Y 50,000 shares. The public applied for 70,000 shares. Required determine the liability of X, Y and the company. So they are asking for the liability for X and Y as well as how much the company, right? So the total number of applications or shares issued by the company is 1 lakh shares. The value per share is 100. We must need only for how many shares the company offered, then how much underwritten by the underwriters, then public applied how much like this will be. Okay. So calculation of underwriters liability or statement showing underwriters liability. So we should open for 5 columns, particulars, underwriter X, underwriter Y, then followed by they are asking also company. So the fourth column is company, and then finally total columns. So gross liability. So gross liability for X 30,000 shares, for Y 50,000 shares. How much for the company? That means we the total number of shares taken is 1 lakh. So 1 lakh minus 30,000 minus 50,000. The balance taken as by the company is 20,000 shares. So gross liability of the company is 20,000. So 30,000, 50,000 and 20,000 respectively for X, Y and the company. The total number of shares is 1 lakh. Less applications received. The total number of applications received by the company from the public is 70,000. It should be allocated on the basis of gross liability ratio. So gross liability ratio is, so 30,000, 50,000, 20,000. That means the ratio is 3 is to 5 is to 2. So the applications received are deducted from the gross liability, then only we will find out net liability. So based on gross liability ratio, 3 is to 5 is to 2, the 70,000 distributed to X, Y and the company. So 70,000 into 3 by 10, 21,000. 70,000 into 5 by 10, 35,000. 70,000 into 2 by 10, 14,000. The total is 70,000. After the applications received, that means this application is called as unmarked applications. It should be deducted from the gross liability, then we will get net liability. So 30,000 minus 21,000, 9,000. 50,000 minus 35,000, 15,000. 20,000 minus 14,000, 6,000. So the overall net liability of X, Y and the company is 9,000, 15,000, 6,000 respectively. So total liability for these three category of people is 30,000. That's it. Right. Problem number 2. Skyleka issued 30,000 equity shares of rupees 100 each. 75% of the issue was underwritten by Prakash. Applications for 21,000 shares were received in all by the company. Determine the liability of Prakash. Here we have only one underwriter, that means single underwriter. So statement showing liability of Prakash. Particulars single rupees column is enough because they are asking only for determine the liability of Prakash. So particulars then shares because they are issuing only shares. Gross liability. So the total shares issued by the company is 30,000. Out of 30,000, 75% of the issue was underwritten by Prakash. So 30,000 into 75 divided by 100. So the gross liability of Prakash is 22,500. Less marked applications. So marked applications. The applications received by the company is 21,000. So out of 21,000, 75,000, sorry, 75 percentage is taken as for Prakash. So marked application 21,000 into 75 divided by 100. So it is get 15,750. This amount deducted from gross liability. So the remaining 6,750 shares is net liability of Prakash. Right. So problem number 3, it should be a little bit differ from the previous problem. Okay. So Velu Limited issued 1 lakh equity shares. The whole of the issue was underwritten as follows. So A 40%, B 30%, C 30%. In the first problem, only two underwriters. They will take a certain limited shares only. The remaining taken by the company. Here, the whole issue was underwritten as follows. So, whole the issue underwritten by A, B, and C. That means it's a complete underwriting. The previous one is previous two problems comes under the category of partial underwriting. So, so applications for 80,000 shares were received in all, out of which applications for 20,000 shares had the stamp of A, those for 10,000 shares that of B, and 20,000 shares that of C. The remaining applications for 30,000 shares didn't bear any stamp. Show the net liability of underwriter. So they have overall received 80,000 applications, out of which 20,000 for marked as stamp of A, 10,000 stamped of B, and 20,000 stamped of C. So from 80,000, 20,000 plus 10,000 plus 20,000, total is 50,000. That 50,000 shares comes under the category of marked applications. The remaining 30,000 applications didn't bear any stamp. That means the 30,000 applications comes under the category of unmarked applications. Now they are asking for show the net liability of each underwriter. for how much liability for A, for B and C. Let us solve it. So statement showing liability of underwriters. So we have three underwriters under total column also. So particulars underwriter A, underwriter B, underwriter C, then total. Gross liability of underwriter is, so the total shares offered by the company is 1 lakh, out of which 40 percentage underwritten by A, 30 percentage underwritten by B, and C also 30 percentage. So 1 lakh into 40 by 100, 40,000. 1 lakh into 30 by 100, 30,000. Looks like same for C. Then put the total of 1 lakh shares. Less market applications. Market applications separately given in that problem for how much for A, how much for B, and C also. So for A's market application 20,000, B's market application 10,000, C's market application 20,000. So total market application is 50,000. It should be deducted from the gross liability. Then after deducting the market application, we will get the remaining liabilities 20,000 for A, 20,000 for B, 10,000 for C, totally 50,000. Then less the market applications on the basis of gross liability ratio. So here gross liability how to calculate, gross liability ratio how to calculate. So 40,000 is to 30,000 is to 30,000. So we should cut it 4 zeros, then we can't minimize again. So 4 is to 3 is to 3. So as per the 4 is to 3 is to 3, the unmarked application, the total unmarked application is 30,000 as per the problem. So the 30,000 shares distributed to among the different underwriters. So 30,000 into 4 by 10, 12,000, 30,000 into 3 by 10, 9,000, 30,000 into 3 by 10, 9,000, totally 30,000. After deducting the unmarked application from the remaining liability, we will get net liability of underwriter. 20,000 minus 12,000, 8,000, 20,000 minus 9,000, 11,000, 10,000 minus 9,000, 1,000. So overall liability is 20,000. That's right. So problem number 4. Rajan and Shyam have underwritten the issue of 10,000 equity shares of rupees 10 each by X Company Limited in the ratio of 6 is to 4. The company received 8,000 applications, of which 4,000 and 2,500 were marked in favor of Rajan and Shyam respectively. Determine the obligations of underwriter and give journal entries in the books of the company. So Rajan and Shyam are the underwriters. The company offered 10,000 equity shares of rupees 10 each. So they should taken in the ratio of 6 is to 4. So out of 10,000, Rajan taken 6,000, then Shyam taken 4,000 shares. The company received overall applications is 88,000 applications, out of which 4,000 for Rajan and 2,500 for Shyam. That is called as marked application. So totally received 8,000. So out of which 4,000 plus 2,500, 6,500 applications are called as marked applications. Then the balance of 1,500 shares comes under the category of unmarked applications. It should be distributed on the basis of gross liability ratio of Rajan and Shyam. They are asking for what is the obligation of underwriter. That means they are asking for what is the liability of underwriters, as well as they are asking for give journal entries in the books of the company. Right. So statement showing liability of underwriters. So here we have two underwriters. So particulars Rajan, Shyam, then total column. Gross liability as per the ratio. So total shares is 10,000. So it should be distributed to Rajan and Shyam as per the ratio of 6 is to 4. So 6,000 and 4,000 shares respectively to Shyam and Rajan and Shyam. From gross liability, we first deduct marked applications. So marked applications are already given in that problem separately for Rajan 4,000, for Shyam 2,500. So totally 6,500. After deducting marked applications from gross liability, the remaining liability for Rajan is 2,000, for Shyam is 1,500, total 3,500. Less the unmarked applications. How to find out the unmarked applications? So total applications received by the company is 8,000. From we deduct the marked applications of 6,500 shares, the remaining shares 1,500. it is considered as unmarked applications. It should be distributed to Rajan and Shyam as per their gross liability ratio. So 1500 into 6 by 10, 900, 1500 into 4 by 10, 600. It's totally 1500. After deducting the unmarked applications from the remaining liabilities, we will get net liability of underwriters. So 2000 minus 900, 1100, 1500 minus 600, 900, totally 2000. So what are all the journal entries to be posted in the books of X company limited? So as per format particulars, then debit column and credit column, 2 rupees columns. So first the allotted to the general public. Bank account data to equity share capital account 8,000 into price per share is 10. So 80,000, 80,000 respectively in debit as well as credit columns being share allotted to the public. Then the second entry, that means how many shares taken by the underwriters. So Rajan account data, Shyam account data, to equity share capital account. So their liability. We find out in the previous step. Sorry. Yeah. Yes, this one. So net liability of underwriters 1100, 900. It should be posted in the second entry. So Rajan account 1100 into 10, 11,000. Shyam account 900 into 10, 9,000. So total equity share capital is 20,000. Being shares to be taken by the underwriters. Then underwriting commission to the underwriters. So the company offered equity shares. So the underwriting commission is 2.5 percentage for equity shares. So underwriting commission account data, that means the total value of share capital is 1 lakh into 2.5 divided by 100, 22,500. So for Rajan, 2,500 into his gross liability ratio, 6 by 10, 1,500 to Shyam account, 2,500 into 4 by 10, 1,000. So total 2,500. Being underwriting commission is payable. Then uh, amount received from underwriters. Okay, so bank account data to Rajan account to Shyam account. So the total amount received from underwriters is so the total liability is 2,000 shares. Number of price per share is 10. So 20,000. Out of which we should deduct the underwriting commission 2,500. Then the net amount received from the underwriters is 17,500. So from 17,500, we should get how much amount from each underwriter based on their gross liability ratio. So amount received 17,500 into from Rajan by his gross liability ratio 6 by 10. So 10,500 to Shyam account 17,500 to 4 by 10, 7,000 being amount received from underwriters. Problem number 5. A company issued 50,000 equity shares of rupees 10 each at a premium of 10 percentage and 2,000 debentures of rupees 100 each at rupees 95. 80 percentage of the issue is underwritten by Singh and Company at a maximum rate of commission allowed by law. Applications were received for 40,000 equity shares and 1,500 debentures, which were accepted and payments for this received in full. Generalize the following transactions and show the entries in balance sheet. So the company issued 50,000 equity shares and 2,000 debentures, out of which uh, 80 percentage of the issue underwritten by Singh and Company. Right? So 50,000 into 80 by 100, 40,000, then 2,000 into 80 by 100,000. Right? So they are asking for journal entries and how it should be posted in the balance sheet. Before that, we should calculate the liability of underwriters. Right? Yeah. Statement showing liability of underwriter, that means Sink and Co. So here they have taken two types of securities, shares and debentures. So particulars, then shares and debentures. Gross liability 50,000 into 80 by 100, 40,000. 20,000 into 80, sorry, 2,000 into 80 by 100, 1,600 shares. Less applications received from 40,000, 80 percentage is 32,000. 40,000 applications received. Out of 40,000, we will calculate only 80 percentage. So 32,000. From second application received is 1,500. That means debentures received is 1,500. From 1,580 percent is 1,200. So net liability is 40,000 minus 32,000, 8,000. Then 1,600 minus 1,200, 4,000. That is the liability. Now we should post the entries in the books of a company. Particulars, debit rupees, credit rupees. First we should share allotment to the public to securities premium. Okay. So bank account data, equity share capital account data, sorry account to securities premium account because the company offered their shares at 10% premium. Okay. First we should calculate share capital value. So number of shares subscribed by the underwriter is 40,000. 40,000 into price per share is 10, 4 lakhs. So then we should calculate the securities premium 4 lakh into 10 by 100, 40,000. We should add share capital value as well as securities premium. Then it should be get in the form of cash. We should post in the form of bank in the entries. So 4 lakh 40,000. Being shares allotted to the public with securities premium. Then the second entry, again they should offer for debentures. So bank account data, discount on issue of debentures account data because they are issuing their debentures at rupees 95, face value is 100. That means they will offer their debentures at discount. Okay, so bank account data, discount on issue of debentures account data, two debentures account. First we should make the debentures value. So number of debentures is offered 1,500. Price per share is 100. So 1,50,000. So 1,500 into actually they are receiving 95 rupees per debenture only. So 1,500 into 95, 1,42,500. Then the difference between the debenture value and the cash value, that is called as discount, or otherwise we should make calculation 1,500 shares into discount per share is 5. So we will get 7,500. Being debentures allotted to the public with the discount. Then shares taken by the underwriters. That is the entry. So here underwriter is called as Sink and Company. So Sink and Company account data to equity share capital account to securities premium account. How many shares they will get it? So 8,000 into 10, 80,000. Then securities premium 80,000 into 10 by 100, 8,000, totally 88,000. Being the shares to be taken by Sink and Co. If you have any doubt, the net liability, that means 8,000 shares and 400 debentures. That should be taken for the third and fourth year, right? So Sink and Co account data to equity share capital account 8,000 into 10, securities premium account 80,000 into 10 by 100. So totally 88,000. Then looks like for debentures, Sink and Company account data, discount on issue of debentures account data to debentures account. So total number of debentures taken by Sink and Co for 400. Price per debenture is 100, so 40,000. So Sink and Co get only for in the form of discount. So 400 into 95, 38,000. Then discount is 400 into 5, 2,000. Being debentures is to be taken by Sink and Co with the discount. Then underwriting commission payable entry. Underwriting commission account data to Sink and Company account. So they will get in two form of commissions. First we should calculate for shares, then followed by debentures. Okay. So 40,000 into 11, that because they are issued at a premium. Okay. So price per share is 10, premium is 10 percentage. That means price per share is with premium is 11. They will get 2.5 percentage for equity shares. That means amount is 11,000. Then followed by debentures 1,200 into 95, they will get eligibility for 1.5 percentage. So 1,710. Then the liability of debentures is again 400. So 95 2.5 percentage because it is taken by because of 32,000 plus 8,000 in equity shares they will get in both cases 2.5 percentage, but debentures the public applied 1.5 percentage, uh, underwriter kept themselves 2.5 percentage, so we should calculate separately for totally 1,600 debentures. Okay, so for 1.5 percentage commission 1,710, for 2.5 percentage commission for debenture is 950. So totally we should add these three commission for shares and debentures. It is comes on and for value of 13,660. So underwriting commission account data 13,660 to Sync and Company account 13,660 being underwriting commission payable. Then the last entry amount received from underwriter, that means from Sync and Company. Bank account data, we should calculate how much from shares, how much from debentures to Sync and Company account. So total amount is 88,000 minus the 11,000. 11,000, yeah, right. So total amount received from Sinclair Company 88,000, but the company make the payment for commission to Sinclair Company 11,000. After deducting the underwriting commission, the remaining amount is 77,000. From debentures, the total amount received from Sinclair Company 38,000, but their underwriting commission under the category of debentures is 2,660. After deducting this value, they will make the payment. Remaining amount is 35,340. So totally 1,12,340. 1,12,340 being amount received from underwriters. This is the journal entries for in the books of the company. Yeah, and also they are asking for how to post in balance sheet. So balance sheet of a company. So we should they are not asking for as per the prescribed format. So we should open for the T format. Liabilities rupees, assets 2 rupees columns. Share capital 48,000 equity shares of rupees 10 each, 4 lakh 80,000. Securities premium 48,000. Debentures 1,900 into 100, 1 lakh 90,000. On the other hand side, cash at bank 6,94,840. Discount on issue of debenture 9,500. Underwriting commission 13,660. So overall total for both sides 7,18,000. Here the cash at bank, we should add all the bank columns of the entry, right? 4,40,000, then 1,42,500, then followed by 1,12,340. After adding these three figures, we will get cash at hand. Then discount on issue of debentures, underwriting commission, both are comes under the category of miscellaneous expenditure category. Right? This is the entry for made in the balance sheet. So the final problem for problem number 6. A company limited has authorized capital of rupees 50 lakhs divided into 1 lakh equity shares of rupees 50 each. The company issued for subscription 50,000 shares at a premium of rupees 10 each. The entire issue was underwritten as follows. For X, 30,000 shares. For Y, 15,000 shares. For Z, 5,000 shares. So total shares is 50,000. So entire issue, that means it is complete underwriting, but they are given within bracket form underwriting 5,000 shares. For it in X, for Y 2,000 shares, for Z 1,000 shares. Out of this 45,000 shares including firm underwriting were subscribed the following were the marked form. So for X 16,000 shares, for Y 10,000 shares, for Z 4,000 shares. Calculate the liability of each underwriter. So they are given within bracket firm underwriting. That means we should use it in the second formula. So we should calculate the net liability of each underwriter in the firm underwriting method, right? So statement showing net liability of underwriter. Listen, we should use it in two ways. Firm treated as marked as well as unmarked. In this question, they should nothing mention the firm is treated as marked and also unmarked. But I will work out for both ways. If in case they have mentioned calculate the liability of each underwriter, if the firm is uh, S marked or marked firm or unmarked firm. If in case nothing mentioned, you should calculate only for the marked firm. Okay. If in case calculate the liability of each underwriter, if assume as firm marked as marked firm, B marked as unmarked firm, like this means we should work out in two ways. Right. So statement showing net liability of underwriter, firm treated as marked. So particulars, three underwriters, then total column. Gross liability 30,000, 15,000, 5,000, totally 50,000. Plus marked applications give separately in that problem 16,000, 10,000, 4,000 respectively to X, Y and Z. After deducting the marked applications, then we will deduct firm underwriting. Firm underwriting also there it includes in the gross liability. Okay, so 5,000, 2,000, 1,000 respectively. After deducting the firm underwriting, they will have some remaining liability for X 9,000, for Y 3,000, for Z nil, total is 12,000. Less unmarked applications. The total applications received is 45,000, out of which the marked application is 30,000. The remaining 15,000 is called as unmarked applications. From the 15,000, we should deduct the firm underwriting 5,000, 2,000, 1,000, totally 8,000. After deducting the 8,000, we will get 7,000. That is called as unmarked applications. It should be distributed to among the three underwriters X, Y, and Z on the basis of gross liability ratio. So, how to calculate gross liability ratio based on their gross liability? So, 30,000 is to 15,000 is to 5,000. So, first cut it three zeros and 30, 15, 5 is divisible in the number of 5. So, 6 is 3 is to 1 is the ratio. So 6 is 3 is to 1. We should distribute the 7,000 unmarked applications to X, Y, and Z. So 7,000 into 6 by 10, 4,200. 7,000 into 3 by 10, 2,100. 7,000 into 1 by 10, 700. Totally 7,000. After deducting the unmarked applications, we should find out net liability of underwriters. So net liability for X 4,800, for Y 900, for Z minus 700. We cannot put minus, but we should put in the bracket 700. Totally 5,000. Okay. So in the excess surplus of Z, it should be beared by the remaining underwriters X and Y of their gross liability ratio. So less surplus of Z. So 700 surplus applications or shares were to X and Y of their gross liability ratio. So 30,000 is to 15,000. That means 2 is to 1 or 6 is to 3. Right. So 700 into 6 by 9 or 2 by 3. 467 for Y 223. We should adjust in X column 700. Already we should post in the negative form. Now we should post in the positive form. Then only we should get nil. Okay. So don't count as in the total column because it includes in the 5,000. Right. Then after deducting the surplus of Z from the net liability, 4,333 for X, then 667 for Y, for Z nil. Then after that, deducting the surplus of asset, we should add firm underwriting. So firm underwriting, they are already given 5,000, 2,000, 1,000. We should add with the, after adjusting net liability, we will get total liability of each underwriter. So 9,333, 2,667 and asset for 1,000. Okay. So that is the total liability of each underwriter under in case of the firm is treated as marked. Then followed by second method, statement showing net liability of underwriter if firm is treated as unmarked. What is the difference? We should discuss. So as usual, particulars X, Y, Z and total columns. First, we should post gross liability 30,000, 15,000, 5,000, total 40,000. First, we should deduct marked application 16,000, 10,000, 4,000 respectively to X, Y, and Z. After deducting the marked applications, we will get 14,000, 5,000, 1,000, total 20,000. The previous step, that means marked form, means we first deduct form underwriting. Here the form is treated as unmarked, so no need to deduct the forms underwriting. We should directly less unmarked applications. So totally we have 45,000 minus marked application is 30,000. So the remaining application is 15,000 taken as unmarked applications because the form is taken as unmarked on the basis of gross liability ratio of the three underwriters, right? So 9,000, 4,500, 1,500 respectively. After deducting the unmarked applications, we will get 5,000 for X, 500 for Y, and minus 500 for Z. Okay. So here we have surplus from Z. So surplus of Z prepared by other liability X and Y. So in there gross liability ratio 6:3. So 500 into 6 by 9, 333. 500 into 3 by 9, 167. Again 500. Okay. Then its net liability is 4,667, 333 for X and Y. Result is nil. Then add firm underwriting as usual. 5,000, 2,000, 1,000. So 9,667, 2,333 and 1,000 respectively to X, Y and Z. That is the difference. If the form is treated as marked, we first deduct gross liability after marked applications. If the form is treated as unmarked, we uh, cannot deduct form underwriting. That is the difference between these two ways, marked and unmarked forms. Thank you.